First up, let's look at the mood of the markets this Tuesday morning as they opened in the green. Well, as expected, taking a cue from its Asian peers as well as the US markets, the Nifty 50 is up 1.5% or so in trade this morning. So is the story with the Sensex. Volatility, remember, volatility had increased by almost 70% yesterday. The fear index, as many are referring to the Indian VIX, has ebbed down today. Indian stock markets volatility now down to about 20. We are seeing handsome gains this morning in the small cap and mid cap space. The Nifty small cap and mid cap indices are both up about 2% or so in early trade. Let's look at the Nifty 50 heat map. Well, this is something that I think all investors were waiting for. We saw a sea of red yesterday. Tables have turned completely on the Indian markets, and this is a green start, green shoots as many would refer to it, now emerging on the Nifty 50. Well, just one piece of surprise coming in from TCS, which is down about 0.5% or so in trade today. This despite the tech-heavy US Nasdaq that closed in the green yesterday, impacting all other IT stocks positively. Remember, Infosys and Wipro at one point yesterday were nearing almost a 9% decline before their swift recovery. This morning, Infosys is up about 2.3%. Wipro is up about 0.8% or so in trade. Look at the auto sector there. Tata Motors, which had taken a massive beating on its chin yesterday, is also up for some sort of recovery, though still far from its lifetime highs of about 1,200 rupees or so. Tata Motors this morning is up about 4%. Well, the mood of the Indian market looking good, isn't it? Feroz Aziz and Mohit Gang both joining me on the show this morning. Feroz, let me start by asking you, as expected, US markets inched up a little higher yesterday, especially the Nasdaq, and even though the Dow and the S&P had fallen, I think the impact that the markets witnessed after Friday's meltdown, which reflected on Monday, today was expected to be a better day, and here it is definitely a better Tuesday.
Good morning, Karthik. Like you rightly said, we were in the oversold, the global market especially, had oversold extensively. During events, emotions take over. So once there is some degree of calmness, then the markets try to rebound. Of course, the implied volatilities yesterday didn't say that. 2650 put closed at 43 rupees with 2 days to expiry. That's an implied volatility of 72%, which means that the markets were not prepared for a gap up. Or at least a positive move. Today, the same put is opened at 8 rupees, which implies now the 72 implied wall has fallen to almost about 19 implied wall, keeping 2 days in mind. That's only one trading day. So 42 rupees didn't indicate the overall sentiments, confidence of the market participants that today will be a great day. But of course, Karthik being Karthik, like I had heard you, being a lot more positive yesterday, like I was on a few news channels as well, saying that these are opportunities to buy when emotions are high.
Right, opportunity to buy. Well, Mohit Gang, I'm not sure investors who are watching this broadcast would have said that yesterday when news reports of 14 lakh, it started with 20 lakh crore rupees wiped out, 19 lakh crore rupees wiped out when the day ended, 14 lakh crore rupees wiped out from the Indian stock markets, and almost 10 months of gains that investors had seen seem to have been erased yesterday. So, I mean, how do you tell investors to deal with this fear psychosis when they see their investments completely in the red? I mean, who will take that plunge and go ahead and buy more when you don't know whether you've hit the bottom or not?
Morning, Karthik. Look, I think to know whether you've hit the bottom or not is a guess game. Anyone who claims to know that, I think, is perhaps either fooling or has some God-gifted talent, right? So my sense is that's never possible. But these are opportunities. These are the kind of days when if you don't enter it, typically you end up never making extraordinary returns in your portfolio. You will always make the par returns which markets will give when you enter the markets at 24,000 Nifty level. You will never make extraordinary returns from that level. But if you enter the market at 21,900 or 22,000 levels, I think that's where the real opportunity is. Of course, you are taking a bit of risk. Of course, there is a chance that markets might further plunge, and that's where the whole prudence idea comes in, which says that you never dip into the river or never test the depth of flowing water with both your feet,
Okay.
right? So you just have to dip your toes in, you have to test the flow of the water, you just have to put in 20-25% of your liquidity and allocate it, and just try and see how the markets calm down and how the markets react over a period of time. You can never go in with all out in these kind of markets.
Right. Okay. Well, dip your toes. Don't insert both your feet in the water. You don't know how deep the water is. Feroz, the markets hate uncertainty. This is something I've learned from you when we've spoken during the COVID-19 days and even more recently, as recently as last week. Markets hate uncertainty. But markets, I think, would hate one word a little more than uncertainty, and that is the R word, recession. Now, with talks even stronger of US potentially heading into recession, we haven't seen the kind of meltdown yesterday, even despite Goldman Sachs raising its probability recession risk for US up to 45%. So how do you think, if the US does go into recession, what kind of an impact should we expect on other markets, including India?
Yes, Karthik. Coming to the recession, the R word, like you called it, that's a great way to refer to a recession. But I would love to borrow the question back from Mohit on that one bit, because we also face this huge difficulty of
Yeah.
how to control emotions of about 12,000 families who have reasonably large amounts. So if somebody's got 10 crores, his portfolio is moving 30 lakhs every day. On times like this, if somebody's got 100 crores, he's seeing 3 crores plus or minus. In absolute terms, those values are so large that it becomes even more difficult to hold on to emotions. So what
Right.
we did a simple exercise for the last 24 years. We looked at the worst financial year day, which was the day which was the least level of Nifty for that specific financial year. We also looked at, if God were to be very kind to you and told you that this was the bottom day, which, like Mohit said, it's impossible to predict, what would be the return? The return was 44% if you could buy on that day.
Okay.
And the average return was 45, best was 92, worst was 11. Now, that's not the point I was trying to get to. I looked
Okay.
at the newspaper headlines of all these 24 days, which was the worst Nifty. Let me pick the latest one, which was 5th June 2024, which
Right.
is the election subsequent day. The newspaper of 4th June, printed on 5th June, read Sensex suffers the biggest loss of 4,390 points, 31 lakh crore wiped off.
Right.
Now, you look at all these 24 days, if you looked at the newspaper headline, those are great lead indicators that you will make abnormally more than average returns. So, whenever you see a newspaper which is giving you a very, very bad picture, like I'm sure today's newspaper I've not read yet because I had a show to do with you. So, that's how we control emotions. We say that अच्छी खबरें और अच्छे दाम साथ में नहीं आते.
Right.
So
So
that really helps us to hold people's gut and
right.
not get too emotional.
Right. Well, one of the headlines I read, Feroz, this morning was tariffied. So the wordplay on terrified, I think the tariff wordplay was into effect. But you're right. I think these newspaper headlines obviously then become a cue for people to go ahead and invest. But Mohit, I think Feroz is referring to the wealthy of the wealthiest. And how does the average retail investor who is, and this is a question I asked Feroz last week as well, but I want to bring it to you, that somebody who's looking at these easy discount brokerage apps with these beautiful pie charts of their investments, how does somebody like that, a retail investor with not too much disposable wealth available, with perhaps not as high a risk appetite as the wealthy folks that Feroz is referring to, how does somebody like that make sense of what to do with their investments? Because there is a confusion in the plethora of news which is coming in that even gold is likely to tank. Gold could touch 56,000 rupee levels is something I was reading. Real estate market is likely to slow down, and crypto is not legal in India. But here you have a situation where markets are continuing to tank. So for the average retail investor looking at these fintech apps, looking at wealth erosion, not with the newspaper headlines, but what is available on the dashboard, how does he make sense of what to do with his or her money?
Yeah. Look, I think Feroz has very beautifully put it out in terms of how to manage emotions and what data points to check and so on and so forth. And there are multiple data points, Karthik, which all of us can quote out here, right? There's in last 44 years of Sensex history, I don't think so there's ever been a year, or there's just been 4 calendar years where markets have tanked less than 10% from the peak levels, right? So corrections are part of a normal market cycle. You will face it. every 3-4 years you will face a 30-35% kind of correction, and every year you will see a 10-15% kind of markdown. Now, coming back to your main question, which is what do a retail investor who is trading on apps perhaps do in these kind of scenarios? Look, I think those retail investors are also watching your shows, are also tracking a lot of news info on YouTube channels, on their digital apps, so on and so forth. And perhaps they would have realized the importance of asset allocation by now. If they haven't, I think these kind of corrections are lessons in right earnest for them to realize that how critical asset allocation is. If they've allocated 60% of their money to equity and 30% to fixed income and 10% to commodities, and perhaps by virtue of market cycle the equities have fallen below 60 and come down to 50, it's the time for them to take equities back to that 60 level. Whether they do it by reallocating the assets within the same thing if they don't have the liquidity available with them, or if they have fresh liquidity they pump in more into equities, is a call which each individual will have to take at their own level, right? And vice versa, if let's say the fixed income allocation has gone up, then perhaps or equities have gone up, they are still sitting on profits, and perhaps they need to rebalance it quickly if they haven't done it as yet, right? So as long as you are sticking to the financial goals, you're sticking to the right asset allocation philosophy, there is no reason for you to panic, right? The problem arises when you are highly allocated to equities, you are allocated to small caps and micro caps, you've not done your own research or homework, you've just gone by tips, you've just seen some channels on YouTube, and you've just invested your corpus. That's where I think these kind of market lessons will always teach you and perhaps make you a better investor in times to come,
All
right?
right.
And yeah, so that's my only take on this thing.
Right, but asset allocation, goal-based investing, Feroz, is something that we've been talking about, hearing experts like you speak for more than a decade, at least to my memory, that asset allocation is important, and reassessing, reanalyzing your asset allocation in a periodic manner, looking at certified financial advisors to give you input. How many investors today really follow that? I mean, we have record number of demat opens in the Indian stock markets and trading. We have record number of mutual fund inflows, SIP accounts, etc., month after month. But the fact is, how many of people are actually following this asset allocation advice seriously and understanding the importance of goal-based investment?
Karthik, I'm reasonably positive that the trend is very, very heartening, and I'll give you some trends. Point one I'm trying to make is, see, when you're moving an elephant, it takes time. Like India's asset allocation itself is wrong. India has not more than 6.7%, 6.8% of the total household savings of 930 lakh crores, including physical and financial assets. We have only 6.7 in equity. How could you have only 6.7 in one out of the two growth assets? So the asset allocation in India is wrong. But is it changing? The answer is it's changing. Will you be able to see it in the next 5 years, 10 years? Maybe you will see it move a little. So I am very hopeful that people, because they're watching Karthik, they're watching so many other responsible media channels, social media, is moving them towards the direction. When you're climbing a big mountain, when you turn back is when you realize that how much have you climbed. Otherwise, you're just looking at how much more to climb. So I'm very positive of how the trend has changed. Second, when it comes to retail investors, I'm surprised and shocked, pleasantly, of course,
All right.
that they have behaved far more mature than HNI. You look at years where markets have shown turbulence, especially 2021 October to 23 October, when Nifty was flat. 2 years, it came back to the same level, October to October expiry. I remember those numbers because it was expiry, 26th October 2023. The SIP numbers went up from 11,000 to 19,000. So the retail guy is actually looked at media channels, responsible ones, of course, like yourselves, and become far more vigilant than the HNI himself. In the same period, HNIs withdrew a lot of money from mutual funds. So that's point two. But coming to the one thing which you asked me and I inadvertently dodged it was the recession part in the US. I'm so happy about this whole global tariff war, because if we wanted, we always prayed that we wanted China plus one, right? That was our narrative. Now today, if there is so much unsettlement, after the dust settles, where will India figure? Will it fall back at the same spot? The answer is no. India will figure significantly better after the shake-up than before the shake-up. Why? Because if China's per capita income is $13,000, US is $80,000, 2,500 is India, and India's labor force is increasing by 15 crore. How can you outsource manufacturing? US will have to outsource manufacturing. Manufacturing can't come at high expensive labor, right? That's why they've always outsourced. So whom will they outsource it to? Vietnam has got more duty. China's duties have, if you sum it up in the three tranches, it is 101 rupees compounded.
Right.
India is 27%. So I'm very hopeful once the dust settles, India's positioning will be significantly better in the global trade than where it is, especially given the US is desperate to outsource manufacturing because it does not have cheap labor. And they have also driven away migrants. So where do they get the cheap labor from?
I couldn't agree more with you, Feroz. And Mohit, isn't this something that we noticed in the Indian markets also yesterday, when the Indian markets had actually taken the impact of the global meltdown much better as compared to its Asian peers? I mean, look at Hang Seng, which was down about 13% in trade yesterday. Taiwan was down more than 10%. You had, the Nikkei and the Kospi also down, if I remember, about 7 to 8% or so. But India finally closed just 3%. And news coming in this morning that Apple, and this is perhaps, corroborating what Feroz was just saying, that Apple is more likely to shift its production from China to India and enjoy a benefit of a reduced tariff. I mean, it's still high, it's still 26%, but as compared to 54% or what Feroz is saying, more than 100% compounded, this entire China plus one narrative may finally play out in favor of India, Mohit.
Oh, yes, I think the new world order which will emerge post this entire scenario will have a favored position for India. But the quick question out here is as to when that world order emerges and after how much turmoil does it emerge, right? Relatively, yes, India stands in a much better shape. We have seen that yesterday Indian markets corrected only 3% vis-a-vis all the global markets which were crashing like anything, right? But if you see for a 5-month period, then I think perhaps the European markets and the US markets were doing much better, or even the Hong Kong market was doing much better than what Indian markets started correcting much before that, right? So depending on what time frame do you want to see, I think give or take markets have corrected because of this global mood check which is happening. However, look, I think I don't know how long this entire thing will last. From an
Right.
Indian perspective, we will have an FTA going with US pretty soon, or a bilateral agreement going pretty soon. But will that end all the problems? Will that perhaps give a kick up, fillip to the market? I'm not pretty sure. I
All
think
right.
markets will only turn globally once they see US and China settling their scores. Which way the dice will roll, it's anyone's call right now. But I think US and China need to settle down on the table first before the global markets can actually settle down. And my sense is that's still it will take some time for both of them to actually give inches away. So yeah, we'll have to wait and watch for that scenario to unfold.
Right, of course, we will have to wait and watch. We will have to wait and see how the dust settles. But from what I see right now, and Feroz, correct me if I'm wrong, is that the trade war is actually between US and China. India happens to just be collateral damage, which means that no matter what, India's chances of coming out with a more favorable position vis-a-vis the US seems to be a high probability event, at least as compared to what China is likely to come out with, no matter how the trade negotiation, retaliatory tariff that now US is threatening China with. It seems that India, being also fundamentally strong at the moment, a large consumption economy, is likely to emerge stronger. Is that something that you would at least agree with prima facie right now, given what you're seeing in the world, Feroz?
I couldn't agree more that this is going to be a long drawn process. And it is going to have ifs and buts. But what happens is markets start finding new news for itself, right? Market starts finding now, if tomorrow you have monetary policy 9th of April, which is tomorrow, then that takes precedence. What I'm trying to get to is, as long as the uncertainty is lesser than the period of my investment, and if my period of investment is 10 years, the economic benefit of this shakeup will transpire in my economy. Today, if you look at the nominal GDP and Nifty's correlation on 11-year basis, it is 90% correlation. So if my nominal GDP is growing at 11% for the next 10 years, and this solidifies that argument, then I have 11-12% from Nifty, and some sharp fund managers get me that 3-4% alpha. Anand Rathi model portfolio has actually delivered 4.27% alpha over Nifty for 11 years compounded. Right? So then I have 14-15%, which is twice more than my debt return. Simplistically, do asset allocation like Mohit Saab said. Now coming to the second part, now you look at the collateral benefit of a recession. When I went to US in December 2022, met 8 fund managers who managed trillions of dollars. Everybody was waiting for a recession so that interest rates, which are abnormally high in the US, The average 10-year yield has been 0.92, but we are still at 4%. That's like India operating instead of 6% repo or 10-year GSEC being at 7 as against 24. If it is 24, it's abnormal for India. Now that has to settle down. So everybody was waiting for recession. Everybody was inducing recession. Today recession is coming. Second, money was not coming. Every NRI I spoke to, he says S&P 500 has beaten Nifty for 11-year period in dollar terms compared with rupee terms. Nifty has delivered 13.5. S&P 500 from 1st April 2014 has delivered 15.5. So no NRI I would speak to would respect Indian market because it was like an FD. S&P 500 ऊपर ही जाएगा मैं पैसे ही बनाऊंगा. That narrative had to be shaken up. Now there could be capital flows to emerging markets because money, naturally, if my home country is going to deliver dollar return greater than the rupee return of Nifty, why would I put money in India? That's why we lost 4 lakh crores. So liquidity can come back. Yields can come back to normalcy. A country can't operate for 20 years at an average of 1% 10-year GSEC and suddenly operate at 4%. All the business economics goes for a 6. So point is, recession is very good for the global market because it's artificial 4%. 4% पे भी कोई पैसा लगाने के लिए तैयार नहीं US में.
That's right.
Right. So that will now shake up the confidence of equity investors of the US, which is deserved. It was a bubble, right? And I think the US equity markets had to have some shake-up in terms of valuations.
And this is that shake-up. Well, one final question to you, Mohit. We are running out of time, so I'll request for a short answer. RBI MPC, Feroz just referred to it, is scheduled for tomorrow, while a 25% basis point cut in interest rate is expected. What commentary from Sanjay Malhotra do you expect on growth forecast for FY26, given all that we've seen in the last 1 week?
Look, I think given the global scenario which is panning out, oil schooling below $60 a barrel, right, which is extremely friendly from an inflation perspective to India. The dollar index coming back to 103 levels, US 10-year hovering around 4% levels, right? And the kind of OMOs which RBI has done recently, it's actually the liquidity scenario has eased off. RBI is in a great shape to go ahead, reduce rates, not just by 25 bips, but even more. But I doubt whether they'll come tomorrow. 25 bips is there for sure, right? That's everyone's call. That's a unanimous call out there. But I'm more keen on hearing the commentary as to what's the commentary, what is RBI, how's RBI viewing the entire global scenario panning out, and are they ready to open the arm chest if required for exporters? Let's say if they were to give some extra line of credit to exporters or some support to exporters, I think those are the cues which markets will be looking at tomorrow. That's the most important part, plus the commentary going forward. How open is RBI to reduce rates further and reduce it faster than what is anticipated?
Right.
I think those are the things which we will look at tomorrow.
All right, Mohit Gang, Feroz Aziz, gentlemen, thank you so much for joining us here on News 9 this morning.